Hi, what we're talking about today is the appropriate tax entity structure for operating a business through and the ramifications of some different choices. Firstly, the most obvious one and the most often used initially is called the sole trader. It basically means that you set up an ABN in your own name and you trade the business personally in your own name. One of the key risks of this structure is the fact that whatever you do in business puts whatever you own personally or jointly with a partner at financial risk, apart from the tax ramifications of it. A partnership can be a partnership of individuals, it might be a partnership of companies, it might be a partnership of trusts. A discretionary trust gives you the flexibility of determining who to distribute profit to, but it has some drawbacks as well. And then a private company, which is now probably the most effective way of operating a business, even though it might be owned by a discretionary trust. The next thing I'd like to highlight is the difference between GST and income tax and how it works together. GST 10% on your sales, offset by 10% on your purchases. Not all things have GST on them, but a predominant amount of expenses and income does. And then how does that link to your income tax? Let's look at an example. What we're looking at here is sole trader versus a private company and the income streams and expenses that go with it. Now what you'll see at the top is the GST inclusive income and the GST inclusive expenses that gives you a net position, and you take your GST impost off. So that GST goes to the taxman. Interesting enough, it's the same net income before income tax, regardless of which entity you're trading through. But this is where the changes are made and the differences hold. In the end, we work down to a tax differential of an extra $11,000 in net profit after tax by operating through a small company. So this is an amazing difference for a small extra cost of setting up a company. Other factors that you can consider when you're looking at tax structures, and very important ones, because from the ATO's perspective, if you do something just for tax benefits, they look at Part 4A tax avoidance. So business risk, the risk of being in business that you take on, whether it be dealing with your clients, whether it be dealing with your staff. Public liability, product liability, what happens if someone's injured themselves for using your product. Professional indemnity, as a professional advice provider, you have risk of people relying on your advice and then having an issue with it afterwards. Employment, as soon as you employ someone, you have the responsibility as the employer for their safety, work cover, so forth like that. Keeping up with your creditor payments, owing people other money, can you pay them on time? Bankruptcy, personal bankruptcy as a sole trader is vastly different from a corporate bankruptcy. A corporate bankruptcy, you may be able to wind the entity up without affecting your personal position. And then business growth, those positives of growing a business. How easy it is to bring in new partners to the business. For instance, it's much easier to issue some more shares. As a sole trader, it's very hard to bring in a partner. So what we've covered today is the importance of determining what is the best tax structure, tax entity to use for your business. The next phase we're going to look at is about looking at the ability to read and understand a profit and loss statement and a balance sheet, because they're your dashboard to your business. If you can't read them, it's going to be very hard to grow a business sustainably. We've got the basics, what to look for, some warning signs about issues that maybe the business may be facing, and then creating an action plan from that information to grow your business even more and more sustainably. Thank you for your time, and we look forward to the next session as well.